Thank you all for joining. We're going to get started here in just about a minute or two. Give a few people just time to log on. So if you just be patient with us, we will get started here in a couple minutes. Thanks. All right, Brian, it's 12:02. Why don't you kick things off?
All right. Hello, everybody. Thanks for joining today's webinar, Retirement and Investing in the Post-COVID World. Today, we'll be covering headline topics such as inflation, rising rates, supply chain issues, amongst other things. Before we dive in, we'll just go over a couple of housekeeping items here, just so you guys are aware. Any questions submitted during the registration will be answered at the end of the broadcast, and our team members will happily reach out if we don't have time to get to your question. The chat feature will be disabled during the webinar, so any remaining questions, just shoot us an email. We'll happily respond to those. We ask that everybody gives us their full attention, because we're not able to provide copies of the recording or the slides immediately following the webinar. But we hope to provide copies in the following weeks once it's approved for sharing. Also, I'd like to inform everyone of Mueller Financial Services' new podcast series called Managing Your Wealth, Your Vision, Our Guidance, which is available on Apple Podcasts, Spotify, and our website, which is MuellerFinancialSolutions.com. With that, I'd like to hand things over to our moderator, Brennan Hollenbeck, who's one of our wealth advisors here at Mueller Financial Services.
Thank you so much, Brian. Appreciate it. Just to kick things off here, in case you're not familiar with Mueller Financial Services, we are an independent financial advisory firm. We were founded over 30 years ago. We have 4 different offices in the Chicagoland area, one in Sarasota, Florida, where we service our clients really across the entire U.S. and even some internationally. With a team of almost 20 professionals, we're ready to help you in the areas of financial planning, retirement, insurance, and tax management. Here at Mueller, we really take pride in working with business owners, families, individuals like yourself to try and help custom design their financial plan or blueprint for retirement, as we call it. We really believe that a strong financial plan is the cornerstone to having a successful outcome for our clients. Now, their investments are obviously a major factor that goes into our planning recommendations. And while we are strategic in nature, meaning we do take a long-term, well thought out approach to how we invest our clients' money, we certainly recognize that times are forever changing, and especially the financial markets are moving faster than ever. Because of our independence, we're able to enjoy excellent partnerships like the ones we have with Putnam Investments. Putnam is a global leader in the space with over 75 years of investment experience, and their various financial solutions can be found in some of our own client portfolios. Now, while we know that COVID-19 has certainly changed a lot of things for us as people, it has absolutely changed the investing game as we know it. And that's why today I'm really pleased to welcome Chris Galipeau. He is a senior market strategist with Putnam Investments, who's going to be taking us through their 2022 investment framework and guidance for the future. So along the way, I'm going to be asking him numerous questions regarding certain trending topics, like Brian mentioned, things like inflation, interest rate increases. We're going to cover the geopolitical conflicts, like what's going on in Ukraine, Russia, and China, and also things like supply chain issues. With that, I'd like to hand it over to Chris, if he'd like to share a little bit more about himself and then further introduce the topic before we kind of get into his and I Q&A. Thanks, Chris.
You bet, Brennan, and thanks everybody for joining and spending, well, it's your lunchtime, it's past my lunchtime, but it's good to be with everybody. I'll tell you a little bit about my background here, as you can see the stock market trading up on your screen. This is my 31st year in the business. I've spent all of that as an analyst and or a portfolio manager on the equity side, managing up to, I guess, about $5 billion on my own. So what we're going to talk about today is we're going to come at it a few ways. As Brendan said, we're going to roll through and talk about things that I'm sure you're concerned about or have questions about. We'll talk about the economy, inflation, etc. We'll also talk a little bit about the stock market and the bond market and what we think is likely to happen here for the balance of the year and maybe even going forward. So I really love doing client events for our clients. It's honestly a tremendous honor to be able to be here with you. So with that said, we'll kick it off here, and I'm going to share my screen. I'm already sharing my screen, but I'm going to pull up something that we use to talk about the areas that Brennan highlighted here. And so I'm going to roll through this pretty quickly. I'm not going to put you to sleep. We'll probably take somewhere around 12 minutes to cover this, and then we'll go right to the question part of it. So we're going to kick it off here and just talk about the economy. And in the first section, we're going to talk about both economic growth here in the United States and around the world, and we're also going to talk about inflation. So I first want to touch on what we expect from the U.S. economy this year and our forecast, and please take any forecast they give you with a grain of salt, because if I've learned nothing over 3 decades as a money manager, forecasting is a very tough thing to do. And if you're going to forecast, you should forecast often, is one of the famous lines on Wall Street. At any rate, we expect the real economy to grow by around 3% this year relative to last year. And 3% on its own is a very big number. If we're right on that or in the ballpark of that, that will be the strongest performance for the US economy in 18 years. Last year notwithstanding, which was the strongest performance in 40 years. So back to back here, real GDP last year of 6%, somewhere around 3% this year, is the strongest performance back to back years in the US economy that I've seen in 31 years as a professional money manager. So I'm going to get to what I think that means here in a bit, but the biggest takeaway from that is we should see a continuation of very strong corporate earnings, which we have absolutely seen in the last 2 years. S&P 500 companies, there's actually 505 companies in the S&P 500, so you know, have doubled their earnings in the last 2 years. And we're going to talk about what we think on a go-forward basis, but suffice to say, 3% economic growth is good enough to keep earnings moving in the right direction. But we have to deal with the situation in Europe and this conflict, which no one could see coming, which is a very good example of why forecasting is so hard. What we've all seen and experienced and probably will continue to experience is higher prices in our everyday lives. And a lot of that is from the scenario with Russia and Ukraine. Commodity prices through the roof. You name it, it's up. Whether it's prices at the pump, I think just this week or maybe yesterday, the average price for a gallon of gas in the United States hit an all-time record high. I'm sure you're all aware of that. Food prices up, whether you're going out to eat, whether you're going to the supermarket. And it's not just 1 or 2 items, it's everything. So this conflict has caused a real problem, and hopefully this ends as quickly as possible. But higher commodity prices will act as a brake on economic activity, not just in Europe, but around the world. And normally the United States is pretty well insulated from a global conflict. This is a little bit different because Russia and Ukraine are major exporters of things like oil, natural gas, wheat, corn, and many other things. So a little bit of a slowdown here in 2022. Overseas in Europe, specifically, Europe is in a tough position here. We expect a recession in Europe in 2022, probably accompanied by stagflation, which really the definition of that is low or no economic activity with very high inflation. And so they're in much worse shape than we are. With all that said, unfortunately, we've been of the view that we like the US over Europe for the last 10 years. We've been right on that. And that view is probably stronger now for 2022. Over in emerging market countries, if you're interested, higher commodity prices and a stronger US dollar relative to local currencies will also act as a brake on economic activity in those countries. Something like 3/4 of every paycheck for every citizen that lives in an EM country goes toward basic necessities. Think food, heating or cooling, gas for the car, that sort of thing. So that is a huge number on a percentage basis relative to the median amount in the United States. So we expect EM to slow down as well. All in here on the growth side, folks, we think the US is the best spot on the planet. And when it comes to inflation, this picture that you can see here is core inflation in the United States. And this chart goes back to 1960, and you can see this pretty violent move up here in the last 2 years. About half of that move up is directly related to the pandemic, the subsequent shutdown, and the impacts of COVID on supply chains around the world. This probably is not going to get any better anytime soon. In meeting with management teams here in the first quarter and listening to them talk about their state of their business, regardless of the industry the company was in that we were meeting with or listening to, every management team talked about this. So I think this headwind is with us. The only good news around this is we've seen a tremendous demand pull forward and a demand shock in the last 2 years, mostly centered on goods, durable goods. Think things like cars, refrigerators, furniture, washers and dryers, etc. That's where most of the inflation has been, because a lot of that, frankly, is made overseas and has to get shipped back here. So higher shipping costs have been a big headwind and a big driver of inflation. We had a demand shock at the same time we had a supply shock, and so as a result, prices went through the roof. Also, part of this big hook up here in the last 2 years are year-on-year rates of change in things like used cars or things like airfares, right? With the economy shut down, when you're comparing against zero, every incremental step up creates a big rate of change or big delta. That's true in a bunch of areas. Slowly, that should start to come down. Used car prices in the last 2 months have come down about 6%. So I think we may be at the, dealing with peak inflation here, but it's hard to say. We do expect inflation to moderate through the balance of this year. So it's about 5.4% excluding food and energy. And as you saw this morning, if you saw it this morning, it's 8% including food and energy. So it is a real problem. This is the highest levels of inflation in 40 years in the United States. The central bank, admittedly, is behind the curve in dealing with this, and we expect them to continue to raise rates, and we'll talk about that more in a little bit. So high inflation is here with us for a little while, I think, at least the balance of this year. The good news is that the best hedge against inflation over time is the stock market. Let's talk about the stock market. That's a good segue. Right now the S&P 500, the broad index for the stock market in the United States, is trading at a level of about 400. As you can see, we think there's a chance it finishes the year somewhere around 4,500. That's up 10% from where we are. I think the environment that we're operating in here now is one of the most difficult that I've ever been through in 30 years, and I've been through a lot, including 9/11, including 99 and 2000 and that bubble bursting, including the global financial crisis in 08 and 09, including COVID in 2020. This is as complex a situation as I've seen. So my expectation would be that with all these cross currents, high inflation, the Fed getting restrictive, a land war in Europe causing inflation, we expect the volatility to remain high here. So what we're seeing and what we have seen in the last 3 months, big moves in the stock market, is likely to continue on a go-forward basis. The good news is that corporate earnings have held up very well. And the only thing that really matters over time for the stock market is the rate and the pace of corporate earnings. One of the things I've been worried about coming into the year, frankly, was that we would see a significant degradation in earnings power for management teams as they talk about dealing with things like wage inflation and higher cost of goods sold. What we found out in the first quarter and listening to earnings reports, is that the elasticity of demand has held up very well. That's a fancy way to say that all of us as consumers so far have been willing to pay higher prices, whether that's going to Chipotle, or whether that's for a used car or a new car, or whether that's your utility bill or gas at the pump or food in the grocery store. So far, the US consumer has held in very well. But I think what we're likely to see here is the stock market focus very specifically on companies that report good earnings, and those companies will be fine. And the companies that don't, that might not have any earnings and say their business is getting weaker, there is no mercy for those stocks. And so we're going through a period here where valuation really matters and the quality of company earnings really matter. And so that's exactly what we focus on at Putnam. Brennan and I have talked about that a number of times and how critical that is relative to what we've just gone through in the last 2 years, where essentially everything went up in price. Every stock went up in price. That part of this move here is over, folks. So expect the water to remain turbulent and expect the wheat to get separated from the chaff, which should be very good for active stock pickers like Putnam and other firms. I want to show you this table because I think this is important. I know there's a lot of data here, but if you just focus on the top line of this table shows us the earnings power for the S&P 500 companies. And one of the things that I hear on CNBC or Bloomberg or Fox Business during the course of the day is this reporting that company earnings estimates are coming down. I'm here to tell you that is categorically false. It's not true. Earnings estimates for the S&P 500 companies have moved up every week in 2022. So despite what's going on with inflation and despite what's going on with this conflict in Europe, despite what's going on with interest rates, earnings estimates have moved up. And over long periods of time, the stock market has a very high correlation, about 1, which is perfect correlation, and stock price movement and company earnings. And as you can see in the out years where it says Y+1 at the top, that's the earnings estimate for next year. And Y+2 is the earnings estimate for 2024. As long as those estimates are still moving up, stock market should be okay. But the biggest risk that we saw coming into this year is right here in the bottom bullet. My concerns were centered around high core inflation and rising 10-year US bond yields. Usually when you get that combination, stock market valuations come down. That is exactly what we're going through here. We don't have an earnings problem, folks. We have a problem with high inflation and rising interest rates, and that combination will put downward pressure, generally speaking, on stock prices. And companies that don't have earnings, or companies that are speculative, that may be telling us they'll make money in 2 years or 5 years, those stocks do not do well in this sort of a backdrop, and that's exactly what we've seen since November. I would tell you this, that based on my own experience here over 3 decades, I don't know when this will stop, the stock market will stop going down, but we are in the ballpark now. We are in the vicinity now. The price decline has been significant. A lot of tools that we use and that have been very effective over time, and I don't mean just my own 30 years, I mean over 50 years, I mean over 100 years, are in place and suggesting that the worst is probably behind us. Sure, we could trade down a little more, another 5 or 10%. But I think what we really need here is just some time. We need some time probably to get through the next Fed meeting, which is in the middle of June, have them raise rates again, have them talk to us again. The more they talk to us and the more we can see the progressive path, the more the stock market will get comfortable with that. The stock market does not like uncertainty, and we certainly have a lot of that now, and that's what we've really been dealing with here in 2022. But I think over the next month or two, this should calm down a little bit. And then we'll finish here just talking about the bond market in the United States, which has had off to one of the worst starts in history. In fact, both the stock and the bond markets are off to some of the worst starts ever here in 2022. You've weathered that storm already, and I wouldn't make any changes. This is why you have a financial advisor and a team of experts to help you. Stay with the plan. We think we're probably nearing the peak here in US 10-year bond yields, and our expectations are for bond yields to moderate. On Monday, they were 10-year yields were 3.20%. Today, they're just under 3%. We think they're probably headed down towards somewhere around 2 3/4. If that's true, and a lot of that will depend on the path of inflation here over the next 6 months. If we're right on that, that should help the stock market stabilize as well. Brennan talked about the pace of central bank policy moves or interest rate hikes. They've already moved twice this year. They've raised the federal funds rate by a combined 75 basis points. And now the federal funds rate is up in the 1.25 range. We think it's likely that they probably raise rates by another 100 to 125 basis points here. My sense of it is they've done a lot of talking and a lot of jawboning, and that talking has done the work for them in so much as it's put significant downward pressure on the stock market. It's put significant pressure on corporate bond spreads, right? And it's caused investors to lose money. And this is part of the process. This is part of the corrective phase. So my sense of it is they will continue to raise interest rates, probably another 50 basis points in June, and then probably sit there and tell us they want to be more data dependent. They want to see if the actions that they've taken have had any impact. Monetary policy works with a very significant lag, probably a year. So the rate hikes that have just gone through here won't have any real impact on final demand for at least another 10 months, right? 8 to 10 months, maybe 12 months. So it's going to be a process here for certainly the next couple of quarters. You may be asking yourself why bond funds are down here on the year. And a big part of that is the move up in interest rates. Bond prices move inversely to interest rates. And so that's the reason that returns in the bond market have been negative here year to date. And the other reason really is that when we enter periods of stress or perceived stress, that bond prices, corporate bond prices also move down. And so we've had the double barrel effect of higher rates in the treasury market and lower bond prices and higher yields in corporate bond space. That combination is putting significant downward pressure on price and causing the losses here year to date. Again, I can't pinpoint this, but the operating fundamentals for corporate America look fine to us. The economy, while slowing down, still is very strong. So the underpinnings here look fine. We're just dealing with some complex issues with regard to rising interest rates and the impact on bond returns and what happens to credit spreads. We're probably through most of this at this point, right? Famous last words. Yes, the water could stay rough for a couple more months. My sense of it is we're probably getting toward the end of it, so hang in there. And Brennan, I think that's mostly what I wanted to share in prepared remarks, so I'll try and take this screen down here.
Yeah, absolutely. So thank you, Chris. And that's, your rhetoric is actually exactly what we have been telling our clients. It's much of the same. I think you unpacked a lot there. And so just to kind of go into some Q&A, you mentioned that the stock market has always historically been the best hedge against inflation. And for those that might not understand that concept and why, can you explain that? Why are bonds not a better hedge, or gold, or just obviously holding cash? You're going to lose money, but why is it that the stock market is considered a good hedge against inflation?
Well, that's a great question. So when you think about cash or bonds that have very low rates on a relative basis, low rates of return, that when inflation rises, your real purchasing power can get diminished significantly. And I don't want to get into what real interest rates mean, but that's essentially the nominal rate minus inflation that takes the returns negative. And so that is the problem here with the bond market right now. So interest rates moving up, causing prices to come down, and the returns are strongly negative here year to date. The stock market, generally over time, companies grow their earnings over time, right? If you look at any 10-year period, rolling period in US history, equity returns are positive in all of them. And that includes things like 1987 and the Great Depression and the Great Recession. So as corporate earnings go, so generally does the stock market follow with very high correlation. So I think that really explains that relationship in a nutshell.
Yeah, I appreciate that. Just want to make sure we touched on that for those that were wondering why the stock market is a good hedge against it. So just kind of getting back to the theme of what the stock is about is investing in a post-COVID world. And obviously COVID changed just so much. What do you think, though, is the single biggest impact specifically to the markets? Is it the inflation that's been caused? Is it the job market disruption? Is it what the Fed has had to do? And I guess it could be a combination of all of them. But I guess what to you is the single biggest fallout from COVID that is causing these markets to maybe go down right now? And then I'm always going to ask you a couple of crystal ball questions. How are we going to feel these effects, right? Is COVID something we're going to feel lingering in all these sectors for years to come, or is it something that you think we can work out through the end of this year, maybe into next, and then kind of look past this?
We'll get past it. The world doesn't end that often, right? That's one of my favorite points. And the storm always passes. We'll get through it. I think the most significant impact from COVID, you saw corporate America bounce back and the stock market bounce back significantly and violently, after that 1 month drawdown in March of 2020. The train pulled out of the station on March 23rd, 2020, and ran hard right through Christmas of last year. So keep that in mind. Phenomenal returns in the last 2 years for the stock market. So a little pullback here is normal. I think the biggest impact from all that has been a combination of the massive monetary and fiscal response to COVID. So taking interest rates to zero, essentially taking the cost of money to zero, and then all the fiscal stimulus that was poured on by the Treasury, right? The Fed controls interest rates, the Treasury controls the fiscal lever. And so, helping out displaced workers in the PPP program and all the other subsequent programs that were put in place, the Federal Reserve getting involved in the bond market to stabilize liquidity. We're past all that now. But I think the problem that we have here now from COVID is the supply chain issue. So you've got skill mismatches in certain jobs. So if a worker wants to go back into the workforce but can't get their kids into childcare, right? That's probably the #1 problem holding women back from the workplace and maybe families in general. People don't talk about that, but that's a very significant problem. And then we have the supply chain issue. Right? We have virtually not everything, but probably 80+% of what we consume here in the United States is made overseas. And I think the easiest example for everybody is the problem we have in new cars and the resulting prices for used cars going through the roof. That is 100% centered on not being able to get certain semiconductor chips, components that go into the car. There's about 3,000 semiconductors in every car made in the United States. The automakers, the OEMs like Ford, General Motors, are missing, 1 or 2 of these chips that they just can't get supply from overseas. Part of that is COVID, a big part of it, but there were disruptions in that supply chain going all the way back to 2019. Big fires, the floods and the earthquakes in Japan, right? We probably don't remember those, but those all had impacts. COVID amplified that. In the current situation here with China and its zero COVID policy, locking down the ports is another major problem. And so I think the COVID, the biggest impact I think on the stock market here on inflation, Brendan, is what's been happening with supply chain. And remember that, and then the war, and then we have this war too that's throwing gas on this fire. So our central bank and all central banks have blunt tools that are designed to either limit demand or stimulate demand. But the tools that they have zero impact on a supply chain. They can't impact supply, right? And further, they, outside of slowing demand, which causes people to consume less food or less gas, they're powerless to do anything about what's happening in Europe and the resulting spike in commodity prices. So this is a very tough situation here where at some point the conflict will end. At some point the supply chain will clear itself up. It's probably not going to be tomorrow or next week or next month. The Fed is trying to gauge how much of this inflation problem is a result of these two things, and that they're powerless to defeat that or impact that. And they don't want to raise rates too much to slow the economy down and put us into recession. So they're trying to land the plane here and land it softly, and it is going to be a challenge.
Yeah, that's the thing is we all have heard that the Fed thought that inflation was transitory, right? Meaning it was going to be a short time and that it would end. Obviously, that is taking a lot longer to work its way through the system. So maybe just touching on today's number, right? The stock market maybe thought that inflation was going to be a little bit lower this month. Can you talk about just, I've heard not just from your group, but others, everyone does have inflation settling down, in let's just say the 4-ish% number, a range, let's call it. Is that realistic over the next 6 months? And is that what the stock market is worried about, is that it's not going to, curb by the end of the year? And then you've touched on it, but I guess just China opening back up from their COVID closures and the war that's going on over in Ukraine and Russia, if either one of those two things fixes itself or works its way out or even shows that it's getting closer, is that what the market is looking for? And the Fed, I guess, too, right?
Yeah. So there's a great saying in Wall Street, it doesn't actually have to get better, it just has to get less bad, right? So managing portfolios, we think about rate of change, right? And I think, I think to myself all the time, how much worse can this get? And we do the reverse. How much better can this get? And that helps us govern our risk taking in portfolios. But yes, if prosperity or peace breaks out, they won't be able to open the stock market. That's how strong it will open up. And so just remember that at some point that is actually going to happen. So the consternation for all risk assets, including the stock market, including the corporate bond market, is trying to deal with the uncertainty around this, exactly what you just said. How long is this going to take? And what if the Fed breaks it? What if the Fed breaks it? Now, the report this morning, the inflation report this morning, the headline number was a little over 8, and the core number, which excludes food and energy, was around 6. The core number was a reasonably significant deceleration in core inflation from last month's year-on-year report. No one's talked about it on TV. Core inflation was actually down 4.8% in, right? You wouldn't have known that. This month, I looked at the last month year-on-year. So there are signs that we see. Used car prices off about 10% in the last couple months. A container shipping freight from Shanghai to LA down significantly in terms of their price. So some of it is already alleviating, but you're right. I mean, the Fed thought a lot of this would be transient in nature, and the supply chain problems have gone on much more significantly than anyone would have thought. But the transient part, they're actually right. I think that they're right on that. The used car situation is a very good example. Airfares are another great example. Through the roof on a year-on-year basis. The comparisons for those two components are going to get almost mathematically impossible, meaning used car prices will continue to have to do this to continue to put upward pressure on the core inflation number. That's already started to roll down. So we will start to see some of this roll down, and that is the underpinning, frankly, to our forecast for around 4% at the end of the year, which is not anywhere near their target of 2-ish%. So it's still elevated to the tune of about 100%. And that is what has the stock market concerned.
I think you said something very important there, and we tell our clients this as well. Focus on your plan, focus on what you can control, and turn off the news, because COVID was a great example, right? In that 1 month of March of 2020, when the world was quote unquote ending, all the stock market was looking for is, what is going to be the end of this? Is there an end game? And then boom, we had one of the fastest rebounds out of a recession that you ever would have seen. So I do think that the news obviously sells fear, and it's trying to dive down into the data, which I think you do a great job of. So going to that, you had a slide. Did you have a comment on that?
No, I was going to say I agree with that 100%. Keep it simple, right? For all the clients on the call here, you've established a long-term plan with your risk tolerances and goals in mind. There's no reason to adjust that plan. Stay with the plan. I think when people, I know that might sound easy for me to say, I have my own plan, I stay with my own plan. And just because I'm a quote unquote professional investor doesn't mean that I don't feel the same emotions that everybody on the call does. Believe me, I do. But what we try and do, it's almost like flying a plane at night, where if you're an instrument rated pilot, you have to rely on the gauges in front of you to tell you altitude, speed, and course. And as long as the gauges are right, we stay with it when the lights are out. And right now, I know it feels like the lights are out. Stay with the instruments, stay with the plan.
I think that's very well said. I might record that for me someday and just play that for my clients.
Footnote me on that.
Going to the numbers though, because you are forward looking and the stock market is forward looking, right? That's how it's always has been. It's never looking back and then deciding. You had a really important slide that touched on earnings growth. And my question to you would be, the year-over-year earnings growth, like you said, is excellent, and even into 2022. Do you think that earnings growth is going to be enough to carry us through this inflationary period? Or obviously the supply chain issues, the wage increases, eventually that's going to start to eat away, is it not, at the corporate profits? What do you say to that? Do you still feel strongly that the earnings growth itself can get through that and kind of punch through this area we're in right now?
Yeah, so what we've heard from management teams, and this is why we meet with company managements and listen to and question the management teams. What we've heard from them is they reported their results for the first quarter. And then what they always do is give us guidance for the back half of the year, for the balance of the year, is that for now, even higher input costs, so higher cost of goods sold, higher SG&A, i.e. wages, for the most part has been manageable. Why? Because they've been able to pass those increased internal costs on to all of us. And that's called the price elasticity of demand.
Yep.
The problem could be if at some point the US consumer says, I'm going to ride my bike, I'm not going to drive my car. And if enough of us do that, then the demand starts to come down and prices will fall. But I think, honestly, it really is going to be on a stock by stock basis. So if you take the companies that in theory are the most impacted by higher cost of goods sold and higher SG&A, then you're talking about all the quick service restaurants, right? So whether it's McDonald's, Burger King, et cetera, that uses a ton of food coming in to sell, and they can't get people to work, so they've had to raise wages. Chipotle is, I think, the best example of this, where they have been able to pass on for the last 4 quarters the higher costs associated with chicken, beef, avocados, and rice, and also their higher wage costs, and put that in what we pay for the burrito bowl. So far, we've accepted that and we've paid that. If it changes, if it significantly changes, specifically if we get into a wage spiral, upward spiral in wages, then that would be an issue. And frankly, we're close to that. But my private fear of significant earnings degradation, barring, if we get into a recession, believe me, there will be layoffs and earnings are going to be in trouble. That has not happened, and that's why I talk a lot about the forward look for earnings, which so far has held in very well, at least for this year, and as you saw, for the out years. Now, undoubtedly, that could change, and it probably will a little bit, but for the most part, Brendan, earnings from Q1 and the guidance was much better than expected.
I think you said it, for those that don't understand inelastic demand, it's just that you are willing to pay higher for that burrito bowl and you're still standing in line at Chipotle. And we see it, right? And like you just mentioned that, whether it's cars or whether it's people buying washers and dryers, there is just such strong demand that they're able to pass on, that to the consumer. Hence their earnings growth year over year is increasing.
Yeah, just because costs go up, the automatic assumption for most people is that operating margins, gross margins and operating margins must come down, and therefore net income must come down. That is not true. That is not true. Could it happen? Sure. But does it have to happen? No.
Yeah. Sticking with just the stock market for a minute before we get into just a couple other topics, I noticed on a slide, you're definitely favoring some more of the value sides of the market, but you did have that you guys like technology. Can you touch on that? Because the NASDAQ has been hurt more than any other in this first year. It's probably the index that is down the most, aside from international. Let's just stay US. Can you talk about the technology sector in general, what you're seeing, why you do still like it, and just the space in general as it relates to the NASDAQ and the pullback? Why such a steep pullback in these great technology companies?
Yeah, well, so we could probably talk for 2 hours about this. I'll keep it right to the point. A lot of the growth companies, right, and this includes Amazon, includes Google, and Apple to an extent. Everyone knows those names, which is why I use those. They generally have outside earnings growth, and as a result, they have higher price earnings multiples, which just means that I'm willing to pay more for the earnings growth that I'm going to get from Google than I am for the earnings growth I'm going to get from, I don't know, Pepsi. And so as a result, and they've continued to report great earnings, right, through this whole COVID situation. And as a result, their PE multiples get high. PE multiples do not like it when core inflation moves up. It just doubled, and long-term interest rates move up. Because when we think about buying a stock at a stock price and we think about where it could go to, one of the tools that we use is called a discounted cash flow analysis, or DCF model. And what we're doing there is trying to forecast out how much cash the company is going to generate out 3 years or out 5 years. Well, anyway, when we do that, when interest rates rise, the cost of capital rises, and the present value of that future cash flow stream comes down. And as a result, I'm not willing to pay as much as I was, 2 months ago for that stock. So that's part of it. The other thing that we have seen that has been catastrophic is the little pocket of speculative tech companies that don't have earnings, that are concepts. And this little part of the technology bubble has burst. This is exactly like March of 2000, and I'm sure everybody remembers that, right? It's not as widespread because many companies now are much higher quality than we had back then, but very similar concept in that you bid stocks up to prices or market cap ranges 100 billion, 200 billion, that companies that have no earnings, that never ends well, and it just got dismantled again. So I think now the focus is on companies that are quote unquote high quality earners, right? That report good earnings and give good earnings guidance, and most significantly, most importantly, generate a lot of free cash flow. Companies can manipulate their earnings, Brendan, but they cannot manipulate cash. And that's what matters. So now one guy's opinion, okay? Now what we have are these big growth companies. I just rattled off the names where their PE multiples have essentially been cut in half from their highs in December to right now. Better part of valor, given enough time here, be a buyer. And I'm not going to give any specific names, but allocating capital into a mandate that goes after high quality companies with high free cash flow generation, you're in the neighborhood here now. On the value side,
go ahead. On the value side.
Just to talk about that for a second. So one of the reasons that certain parts of the stock market perform well in periods of high inflation is that a lot of these companies are they're net benefactors of rising prices, i.e. inflation. Think Exxon, Chevron as oil companies. Think about the steel companies. Think about the big equipment companies like Caterpillar and Deere, where the commodities that they're trying to get out of the ground or harvest, right? I guess out of the ground as well, if you're harvesting corn or soybeans. The farmers are making more money because the price of their crop or the price of oil is rising. They're willing to spend more money on new equipment, or maybe they need it. And as a result, those companies benefit from periods of high inflation. That's why coming out of recessions, value as a style outperforms growth every single time, and it just did it again. Now we're in a situation where real GDP is going to slow, and earnings growth is going to go from widespread to a more narrow lens. And that narrow lens is going to be companies like Apple and other growth companies. And so as GDP slows down, the big growth companies should start to perform better, certainly better than they've performed in the last 3 or 4 months.
Let's hope so. We take the stance here at Mueller of, right now we are equal weight to our growth companies and our value companies, and we actually always use active management like you've been preaching. We are not in the camp that you want to just ride all tides up and down in an index, because like you just said, every company is different when it comes to their quality of earnings and what is their actual cash flow that's coming either back to the company or back to the investors.
Exactly.
So one other thing I would just touch on is you mentioned the international space, because I think that everyone understands why it's challenged. You talked about 2022, a recession. We're in 2022. Can you expand a little bit more on is the international markets investable? We ourselves are underweight international. We always have been to the U.S. just like you are. But does that mean that you completely avoid the international space? Or if they are in this period where things have been discounted 20, 25%, if you're willing to buy quality managers, quality assets, is that something that still at least has a merit in a portfolio? And just expand a little more on the international side of things.
All right. So I have very strong opinions about this. Stocks follow earnings over time. I don't care if the company is based in Boston, Chicago, Beijing, Belgium, it doesn't matter to me. It doesn't matter. And I think a lot of work and effort and consternation goes and hand-wringing goes into this notion that we have to have this global diversification in portfolios. And I don't believe that at all. Right? What we want to find are companies, right? The US leads the world, Europe follows, and EM follows too. Emerging markets is a little more volatile, Europe is a little less volatile. In reality, I'll give you this data point. From 2007, which was just before the great financial crisis, so 2007 out to 2020, that's a 13-year period. In that period, S&P 500 earnings were up 100%. And the S&P itself was also up 100%. In the same time period, in Europe, European earnings were down 32%. So earnings in I'll have to switch hands here. Earnings in 07 to earnings in 2020 were 32% lower. And the index was down 13%. So, and the same is true for EM, the order of magnitude is a little lower. That's been the case, at least in my 30-year career, where if I want to evaluate a company for purchase, do I want to buy a US-based company that might produce power generation, or do I want to buy a European company? And the reality is this, that European economies, some of the countries are socialist or borderline. There's de minimis economic growth relative to the US. And as I just talked about there in that 13-year window, 07 to 2020, not only is there de minimis earnings growth, they lost more money, right? Earnings were lower 13 years out by a third. I have no interest in that. I have no interest in that. And so I think US management teams have significantly more flexibility, more levers to pull, and whether that's controlling costs or, could be a lot of things, but mostly on headcount probably, to preserve profitability. It's much easier here in the United States. So with all that said, when you get periods of dislocation like now, the major European indices are trading at about 10 or 11 times earnings. So on a go-forward basis, is there a lot of risk from here? Probably not. Probably not. And I think people forget that. As stock prices come down, the forward rates of return generally go up, and the risk is coming out. It feels terrible, right? You're losing money, so it hurts, but the risk is coming out, and people forget that.
Very, very well said. I know you're a stock market strategist. We won't call you an economist. I know that. But just if you could touch again on the bond side of things, because I think it is important for people to remind themselves and understand, why you hold bonds and are they still attractive, even, right now at these levels where people are saying, wait a minute, my bond funds might be down 8-10%. But you mentioned something I think is really important, and that's that probably most of it has been flushed out of the system. And just what is the forward-looking guidance if you were, to buy bonds or hold those today as a kind of, let's just call it hedge against what might happen in the stock market? How do you feel about the bond market in general?
Okay, so let's break it down into two pieces. We'll talk about US government bonds first, and then we'll talk about corporate bonds second. And I know that for your clients and for the clients on the phone, you own both, right? And sometimes you own both in the same portfolio, same mandate. Okay, so US 10-year rates here have reacted to the Fed's willingness and desire to raise interest rates. And so we've seen a big move up in 2-year note yields and a big move up in 10-year note yields and even 30-year yields. I think we're probably 80% of the way through that. So the pain you felt as a result of rising interest rates, knock on wood, we're probably in the 7th inning of a 9-inning game here, right? So number one, I wouldn't run away from that. And I think it's probably time to start thinking about adding to that. And the same thing can be said for corporate bonds, frankly, where you've had the double-barreled effect of rising interest rates and the sensitivity of a corporate bond to interest rate market. That's probably in the 7th inning of a 9-inning game as well. So it hasn't, I think the issue that everybody on the call is experiencing here is the assumption is that the reason you own in a 60-40 portfolio, 40% of it is in the bond market, is to act as an airbag in case something goes wrong in the 60%, i.e. the stock market. And that normally happens. The issue we had this year is that the starting level of interest rates was so unbelievably low, mostly driven probably by quantitative easing, i.e. the US government buying its own debt, right? Holding interest rates down. Now was basically allowed to free float more than it was a year ago, and as a result, interest rates have risen. So that's what's caused the pain. And again, I think we're probably through the 7th inning of that. I'm not saying it can't get a little bit worse, but this has been a very rough start, no question. And all of that has been driven by rising interest rates.
So your call is not that the U.S. will likely, go into a recession, let's say by the end of this year. Hopefully we can work through all the things we've talked about. If let's say we do though, right? At some point we're going to go into recession. That's how market cycles work.
Yeah.
What do you think this recession looks like? Is it not as steep? Is it a little less long in duration? It's not going to last hopefully as long as an 08, 09. And we've been telling clients, that's for a lot of reasons. Number one, you talked about earnings growth. We've got really high employment. You got balance sheets of personal, consumers that are much stronger than that they were. And then the banks are healthy. I mean, I listed the reasons. I might have answered your question for you, but if they could hear it from you about why a recession might look different right now. I mean, and to remind people, we had a recession in 2020, right? 2 negative quarters of GDP is a recession, right, Chris?
Yep, that's exactly right. So the first thing I'll just emphasize the point you made there. This is nothing like 2008 and 2009. This is, it's really nothing like 2000. It's nothing like the early 90s. I managed money through all those periods, and the COVID was a different animal as well. That recession, that brief recession, it didn't really unnerve me like 2008 and 9. And 2008 9 was scary. We had big banks going out of business overnight. They were the epicenter of the problem then. And because of the capital constraints and requirements put on the banks, because of what happened in 08 and 09, now banks are probably a big part of the solution here. So that massive financial system collapse that's not going to happen. My guess would be there's a 25-30% of a recession this year, which is up from about 0 coming into the year, frankly, because of what's happened here with commodity prices. But as you point out, we're at full employment. There are twice as many job openings as there are people, wanting to come and fill them. So I think if you want a job, you can go get a job. It's not as if management teams are laying people off en masse yet. Some of the speculative tech companies might, because they're essentially, business models are blowing up. But our best guess would be, a mild sort of recession that, frankly, that might be the case here because the Fed is going to have a difficult time landing the plane. One of the things that we watch carefully is the relationship between 2-year bond yields and 10-year yields. And when 2-year yields, let's see, by the way, folks, my camera's reversed here, so I have to reverse my hands. But when 2-year yields get higher than 10-year yields, that is said to be a yield curve inversion, and that historically is a very good forecaster or predictor of recession in the United States. That actually happened in March for about 3 days. But I think the important thing to note is this, that from the point the yield curve flips around like that, it takes about 16 months, a median 16 months, for any recession to take hold. So that's at least a year and a half away. That's the middle summer part of 2023, roughly. And my sense of it is some part of this problem here will end. The COVID situation, the supply chain situation, hopefully begins to mitigate and at the margin get a little better. If we could get a resolution to this conflict in Europe, even better too. But it doesn't seem plausible that if we did this call a year from now, we're still dealing with the same things at the same amplitude. If we are, we're going to have a problem.
Right. Yeah, I completely agree with that. I'm going to ask you a question that just to comment, if you have one on the real estate market, right? So a lot of majority of personal wealth is tied up in real estate, and people have seen this great appreciation in it. I'll ask you two sides of the question, I guess. Just, do you think these higher prices in real estate are warranted and here to stay? And then on the investing side of things, is real estate maybe still an attractive investment from, portfolio diversification, provides good cash flow? And just what do you think in general, how the real estate market and these crazy prices that have gone up exponentially since COVID, what do you think that's going to have the impact on the market?
Okay, so there's been two factors that have really driven housing prices to the levels, to where we are today. Number one is limited supply, so no homes for sale. I live on the seacoast in New Hampshire, and in the last 3 or 4 years, there have been virtually no houses for sale, and that's changing quickly. So limited inventory, strong demand, all right, causing an upward movement in price. That's economics 101, demand overrunning supply. Number two has been the reality that the cost of money has been zero, essentially. Back in January, you could go get a 30-year loan for under 3%. Today, that loan's almost 5.5%. And so that alone is going to, so with high prices, high and stable prices for now, and a much, 100% increase in the cost of capital vis-a-vis a 30-year loan, that is going to begin to take the marginal buyer out of the picture, and the marginal buyer always sets the price. My guess is this is probably a near-term peak in housing prices right now. And of course, I don't know that for sure, but that's my sense of it. And even here locally in the local market, in the last 2 months, I've seen many more houses come on the market, and houses that have been on the market are coming down in price. And that might not be the same for Manhattan or Chicago, but here in this area, we're starting to see it for the first time.
Yeah, completely agree. Well, we've got about 5 minutes left. Chris, I'll just leave it to you if you have just a minute or two, just final comments, and then I'll give mine as well, and we'll get people out of here.
Yeah, I would say this. First, thanks for having me. I really enjoy doing this, and hope if anyone has questions, get them on to your team, and we'll try and answer them. I think the biggest thing to take away from this is that, yes, the water's been rough. We've had a couple good years. It's been a tough start to this year. I think we're probably through most of the pain. Doesn't mean we can't have a little bit more. But any way you slice it, for the most part, unless there's been a significant change in your life or demands, stay with the plan. If you have questions, you've got your team right here. Run the questions up the flagpole and get the answers that you need. But generally making decisions in periods of high volatility is not a good idea. So stay with the plan.
I like that. And thank you for attending. I can't say how much we appreciate the partnership with Putnam, your insights. I think you gave us a lot to think about. I think, like you said, it is a matter of making sure you have a plan. And for those out there, there's almost 50 people on the call. Thank you so much for attending today. We want to remind you that, if you do want to speak with one of us about either something in particular that we addressed today, a concern or a comment, our contact info is right there. If you're yourself interested in developing a financial plan and making sure that all of your assets and wealth is well planned out for the future, we have a team of professionals that we would be glad to sit down. Everything we do here at Mueller Financial is custom. We're fiduciaries to you all as clients, and we always act in your best interest. And having partners like Putnam gives us great insight into the markets and allows us all of the investment tools that we need to create a successful outcome. So thank you all so much again. We will be sending out a survey after this just to make sure that if there was any questions. And thank you all so much again for attending. Chris, again, can't say enough that we appreciate the time, and we'll be in touch.
Thanks for having me.
Thank you again.